And it seems crazy to me to believe that the BOC isn't paying attention to the fact that once you strip out mortgage interest costs, inflation is way below the revised numbers that they've been looking for publicly for a long time.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Well, we are back at it for a special preview episode today. This is the week that we might have all been waiting for, well, the better part of the last year, specifically if you're someone who holds a variable rate mortgage in the country of Canada. And if you're someone who's on the outside waiting for the crash or the collapse, probably you too, because it seems like that's something you're just genuinely interested in. Today is a big day because we have one more day to wait until the BOC announces what's going to happen. It's going to be June 5th of 2024. The BOC is going to announce their decision on rates and what's going on. And quite frankly, up until last week, almost everyone, including all of the economists and news articles that you're seeing, were suggesting, well, the BOC is probably going to push back rate drops until July, maybe later, September, and on and on. And while there's absolutely zero certainty that Tiff Macklem is going to reduce interest rates, there is a higher probability and the highest probability that we have seen, well, since they started reducing them altogether. Remember this, in the beginning of 2024, many of the predictions that were out there were suggesting that the Bank of Canada was going to reduce interest rates as many as 6 times over the course of the year. Now, I don't believe I ever really personally believe that, but there were some medium ground suggesting at least 1%, so 4 times over the course of 2024. And while that is probably off the table, the idea or the prospect of a rate cut is literally putting the real estate market on hold. We're going to dig deep on that today and a few other key topics that have come out in the better part of the last week. This is a packed episode, but it's going to be short and it's going to be sweet because we're going to have one episode that comes out after the June 5th announcement. So if you haven't already done so, please make sure to go ahead and hit that like button, that subscribe button. If you're listening on Spotify or iTunes, leave us a great review. Leave me a great review. Leave me a wonderful review. And if you don't like the show, well, tell me why, because I'd love to hear it. And I will either listen or ignore you, and we'll see where we go from there. So among other things, there is a higher probability of rate drops, but we're going to talk about this episode and unpack why that's the case. But more importantly, we're going to circle back to a few other key pieces of information and tidbits that have come out in the news over the last week. And it's been a busy week here in real estate. It feels like this entire year. We're on June the 3rd or 4th, depending on when you're listening to this. And the reality is this entire market has felt like every single week we're getting hit with a new tax or regulation or guideline or news or information. And specifically in the mortgage markets, it's been an absolutely turbulent ride from the first month in January, nonstop phone calls and applications and information, to a quieting down in February, March, to an absolute fever of people buying that were pre-approved, quieting down again. And then end of April, beginning of May, a complete mad rush for people purchasing. And now we've seen the last 2 weeks of temperedness, tempered expectations and tempered excitement, I think predominantly because people are waiting for the BOC's rate announcement on June 5th. Now, why people are waiting for the potential of a quarter percent of a rate drop to make a real estate decision worth $500,000 or $1 million or $1.5 million makes zero sense to me. But I guess a lot of people out there believe that this is going to have a major momentum shift in the marketplace. And if you're on the buy side, I don't quite understand the benefit of waiting. If you're on the sell side, I can somewhat understand it because the benefit would be that you could potentially sell and cash in. Although one thing you should remember is that when you sell in a certain market, you're buying in the same market. So it's virtually the same thing across the board. Let's go back a couple of seconds. One thing, without getting into all this BOC stuff, and we'll talk about why this is happening and what happened in the last week to make this confidence level go up. One thing that was really interesting that came out in the news last week was, and if you haven't already seen this, is Trudeau, JT, came out and announced what everybody has been thinking for a long time, but no one has actually said, which is that Canadians' retirement plans are in their homes. Basically, more or less suggesting that, well, even the government does not want to see the housing market crash. because that would actually be awful. That would be terrible for not just the housing market, but that would be terrible for the entire country of Canada, where boomers and the like are literally relying on their primary residences and one day selling them to cash out to be able to fund their retirements. And now, while we can't suggest that's a good strategy, and in fact, I can tell you, I don't believe that's a good strategy, it is the nature of the game. We've been seeing this for decades now, and specifically for the last decade or two. And so Justin Trudeau more or less actually came out and specifically said, let's see if we can find out exactly what he said while I'm talking right now, but he specifically said that Canadians' home values are supporting their retirement, and therefore they don't want to see the housing market collapse. But at the same time, his government is suggesting that we need to find a way to get affordable housing. So you've got two conflicting ideologies. One is affordable housing and one is a housing collapse. The thing that we have to keep in mind, and I'm going to go on a little tangent here, is that this isn't necessarily about housing in Canada. This is about housing in Toronto and Vancouver and most major markets. Because the truth is, the major cities of Vancouver and Toronto are the ones that are really leading the polls as far as house prices, and it's no different than Los Angeles or a New York or a London or Tokyo, where those are the centers of the economic universe of that particular country, and it's expensive to live there. It's not cheap, and it won't be ever cheap. But if you go to the outside cities and areas, there are places that you can buy affordable housing. There's plenty of affordable housing in our country. It's just that people don't want to live there or go there. So the conversation isn't necessarily about affordable housing in Canada. It's about affordable housing in some key cities and not letting house prices go up like a hockey stick for the course of in the course of 1 year, 50% increase in price points. That being said, I mean, this is the one thing that I'm looking at it and say, this is the one thing where Trudeau has made a point that everyone has been thinking, but no one has actually said out loud about real estate values and retirement plans being connected together, which is the truth. And that, if there's any reason that the housing market will not collapse, that alone is one of them among many other. And I'm not going to get into all that in this particular conversation, but I thought that was very interesting when you think about how the Canadian economy is built and what it's built on in many ways, shape, or form. So I thought I'd point that out as we consider the different types of news that have come up in the past week when it comes to mortgage and real estate, because it's very notable to suggest our leader, whether or not you see him as your leader or not, but he has come out specifically and said, again, what we're all thinking at this time right now. Now, I'm trying to glance through and find a particular article right now, but can't seem to find it. And anyway, let's get back onto some other key items that have come up in the last week or two and dig deep into those. The first one is the renewal, quote unquote, crisis. So OSFI's report, which we talked about, we did a really big podcast about the CMHC surveys, and I've talked about OSFI's reporting. One of the things that they came out with in the last 1 or 2 weeks was their reports on variable rate mortgages and the potential of the collapse of the housing market in 2025 or 2026, not the housing market, the mortgage market, specifically stating things along the lines of, they talked about reverse amortization, and they talked about the potentially negative amortization and payment shocks and all of these key considerations. When I see articles like that, the one thing that bothers me the most is that they're missing the fundamentals of the type of mortgage product that they're talking about. And what I'm referring to here is a fixed mortgage payment variable rate mortgage. As you can recall, thousands and hundreds of thousands of people in 2021 and 2022 took these products, and with interest rates increasing over the course of the next 2 to 3 years here, we've seen a dramatic change to their interest components. They're paying basically 100% interest or more than interest, which is accumulating back to the mortgage. But the point of these particular products was always to be there for 5 years so that they could weather the storm. Typically speaking, rate cycles last for 36 months, 24 to 36 months. So if rates were low and then they were to go up, they would likely or hypothetically come back down. We also have tools that we can use, like the ability to re-amortize a loan or stretch it out to reduce a payment. There's so many different means at play. I don't think we need to start attacking products that have been around for decades purely because of one circumstance over a short period of time. I believe truly and wholeheartedly that the vast majority of people who have these types of mortgages are still going to be able to make their payments or refinance or restructure. And there's very few people that will have to sell off their mortgages at the end of 2025 or 2026. And a big part of that is because I truly believe this as well, that the supply issues that we've talked about for the better part of the last year or two have not even come close to working their way through the marketplace. We talk about people coming to our country. Well, that is impacting rental rates, but what it hasn't impacted yet is house prices, because a lot of these people don't buy because they're not permanent residents, and there's foreign buyers taxes, and they're acquiring work and credit and so forth. By 2025 and 2026, a lot of these people, these permanent residents, will have A, earned income, B, become permanent residents, and C, saved up some money to be able to buy a home. And so my belief, my true belief, is that by 2025, 2026, not only will we continue to see the values increase, that will be the year, or those will be the years where property values will really take off. Now, let's take a step back, because I'm going on a little bit of a rant and I'm going all over the place here today. And the point of today's conversation was really, what is Macklem going to do and why is he going to do it? Well, if you haven't heard the news, the Canadian GDP came in very, very low back in, well, what was this? May 31st, I believe, was the date that this came out. No, it was May 30th. Anyways, it was last week, nonetheless. The GDP itself came in at 0.4% quarter over quarter. Q4 growth was revised down to zero, so 0% growth, which is not good. That's really bad. Below the estimates in terms of growth, we also saw some reductions in the US as well, US numbers. And so what was interesting is that we were riding a bond yield growth for the better part of the past 3 weeks now, where the yields were actually increasing, putting upwards pressure on fixed interest rates. Well, when these numbers came out, the market literally did a 180 and the market started buying back the bond yields. And what that means basically is that reduces the bonds, which reduces the cost of fixed rate mortgages. But it also what it also came out with was revised expectations around the BOC's potential rate path. There's literally no reason at this point right now. Well, I mean, I guess there is a reason, but there are very minimal reasons, economically speaking, that the BOC should continue to keep the interest rates as they are right now. If the BOC did not reduce interest rates, they need a really good reason as to why they did not do it. Case in point, a few different ideas. Number one, they want to see these continued trends. I don't know why, but they want to see the trends down to continued lower than 1% GDP growth. They want to see unemployment numbers across the board rising. They want to see more and more insolvencies, more mortgage renewal risk. I don't know why they would want that. And in addition to that, potentially more defaults. In any case, all of these potential things would be an outcome of continuing to wait to reduce interest rates. And it seems crazy to me to believe that the BOC isn't paying attention to the fact that once you strip out mortgage interest costs, inflation is way below the revised numbers that they've been looking for publicly for a long time. Now, we're going to find out in short order what this looks like. But as of right now, the current market rate expectations are that whether it's June or July, the Bank of Canada does reduce interest rates by 0.25% unless something blows us out of the water. By October, the suggestion is that we see at least another 0.5%. That gives us at least 0.5% in the year 2024, which is about half of what we started the year with. By next year, around midsummer, we're expecting a total of a 1% rate drop. So that's 1% below where we are today. The prime is at 7.2% at most banks. That puts us at 6.2%. Now, that's not a massive impact to most people that are on variable rates, but it'll be welcome news, and it will help some families, obviously, to reduce their overall cost. To see those numbers go down faster than that would probably take some type of large economic event. They've obviously publicly stated they want things to go down gradually, and this is going to be the rate path that they see going there. So what does this mean? If you're a mortgage borrower or you are in the real estate market and trying to figure out how do I play this? Well, for the first time in a long time, the variable rate mortgage has statistically and on paper, mathematically, started to make sense when compared to the fixed rate mortgage. Now, barely in some situations, and you have to think about, is this a 25-year, is this a 30-year, is this a high ratio, is this a low ratio, conventional? Those different factors will change the potential outcome of what consumers should do. But if we used a 5% down mortgage, where someone is comparing a 3-year fixed rate with the average lender between 479 to 499 and the variable rate prime -1 to prime -80, somewhere in that range, we smack in the middle and we say, let's use the middle, the median, if you will, of the rates, prime -90 and say 4.89 on a 3-year fixed rate. Now, the variable rate actually mathematically on a $500,000 loan comes out ahead. And the same thing proves to be true for someone who has more than 20% down and a 30-year amortization based on some of the most recent rate promos that we've had access to, unadvertised rate promos that we've been able to secure for our clients at prime minus 90 or better for 20% down scenarios, which has been unheard of for the better part of the last year. Statistically speaking, again, that does give you a minor edge on the variable rate. What we've done recently is we've also been helping secure thousands of dollars of rate reductions for people who took 3-year fixed rates back in the fall and the summer of 2023 at rates above 6 or 6.5%, and then restructuring them into either today's variable rates or fixed rates, short-term fixed, to actually secure thousands of dollars of potential savings before there is a big rate drop. So back on track here. Those are some of the things that we're doing. So what do you do? How do you play this? Well, first and foremost, we're going to find out in just a day or two what's going to happen, what the BOC is going to say. If they don't change rates, you can probably suggest that the housing market will continue to lag forward. It's been pretty soft lately. It's going to lag forward. The buying opportunities are amazing out there for potential buyers or investors. I haven't seen opportunities like this for a long time. I mean, the best market that I could compare this to was in 2022. There was a 1-month gap where when the prices kind of fell off, it was really, really soft. But the problem there is none of the sellers were accepting the price points that they had to. So they just took their homes off the market. So in any case, this is a great market from a buyer, from a seller's perspective. You just have to remember that you're selling and buying in the same marketplace. So I think we'll continue to see price drops and soft markets if the rates stay the same. If they do not, then it's very probable that we see, if the rates do cut, we will see a little burst and a little jump into the marketplace that will fuel probably the rest of the year, unless rates don't drop again, at which point we'll probably see a softening in the winter in expectations of waiting longer and longer and longer. And so what the moral of the story here is, for a variety of reasons, whatever the BOC does here is not going to have a major impact on the reality of people being able to qualify or the cost of borrowing. Nothing major. It'll have a minor impact. But what it does mean is that the psychology of the rate market is completely driving people's decisions. And I truly believe that people have been purchasing in the last 3 months and maybe this month or next month are going to come out so far ahead in the next 2 years because they will have taken advantage of this soft gap where people are concerned and nervous. And when people are nervous, they don't make decisions and they're confused and they have fear. Then obviously the people who do see through that noise can do pretty darn well. Anyways, what I'd like to know from you is, what do you think is going to happen? Send me a message on Instagram at The Mortgage Pug, at Flow Mortgage Co. If you're watching this on YouTube, I'd love to hear your feedback below, but don't just say it's just going to drop. Like, let me know why. I want to understand why you think this is going to happen and what could be the potential outcome in the marketplace. If you've enjoyed this channel, like I mentioned, leave me a great review, send me a DM. If you want to hear more of something, hear less of something, also let me know. I look forward to seeing you or listening to you or talking to you on the next one.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.